Financial statements explained. In this video, I'm going to look at the different financial statements that an enterprise may produce, and there'll be a series of tasks and activities that you can undertake throughout this video, which forms part of a lesson that was taught remotely in the first place. Firstly, let's think about a little task. Look at the following statement of comprehensive income and answer the following questions. So there is your statement of comprehensive income, and there are your 4 questions. How much profit did the owner get to keep? How much did it cost to make the products that the business sold? How much did the business produce in sales? And what is the difference between gross and net profit? Pause the video now while you answer those questions, and then unpause where I show you the answers. Hopefully you're able to calculate the answers. So you can see that the amount of profit that the owner got to keep was £1,700. That was the net profit. And hopefully you worked out that to get your net profit, you need to work out the gross profit, which is going to be your turnover of 50,000, take away your cost of sales of 20,000, which would give you 30,000. And then you needed to add up all your expenses and take those away from your gross profit to get your net profit, or the amount the owner gets to keep. The other question was, how much did it cost to make the products in the business? And that was £20,000. That was the cost of sales. The next question was, how much did the business produce in sales? Well, that was £50,000, because turnover, revenue, sales all mean the same thing, money going into the business. And the last question was, what is the difference between gross and net profit? Well, gross profit is your turnover or your revenue minus your cost of sales, whereas your net profit is your gross profit minus your expenses. Gross is the one that you get to keep and shows you everything once all your costs have been taken away. However, that was just starting to get you to think about the topic. Don't worry if you find that complex, because we're going to explain more in this video. So firstly, a little task for you. Pause the video whilst you draw the table and then go and research into what these terms actually mean. So statement of comprehensive income, turnover, cost of sales, gross profit, expenses and net profit. So hopefully you have now completed that task and you understand what some of the terms mean. However, the first thing to understand here is that a statement of comprehensive income is one of the documents that a business has to produce. This document shows the profit and loss that a business has made over the previous financial year. So it is typically conducted annually or once a year. And this document shows gross profit and net profit. You do need to understand how to calculate gross and net profit, but you just need to remember at this point so far that the statement of comprehensive income shows gross and net profit. The gross profit is calculated by doing your revenue minus your cost of sales. Now, sometimes revenue is called sales revenue, sometimes it's called turnover. However, the formula is revenue minus cost of sales. So in this case here, it's 50,000 minus 20,000, and that would give you £30,000. Now, what that means is that is the profit that you're making from selling your product or service. However, at this point, no other costs have been deducted. You will see that I have other videos explaining gross and net profit, and if you're not fully au fait with what I mean when I say cost of sales, or when I talk about revenue, or even when I talk about gross profit, make sure you check out the other videos that I've got on the channel that will explain this. Now, the other profit you can calculate is net profit. Now, net profit is a profit that you get to keep after all your costs have been deducted. So not just the cost of making the product, but all your other costs like rent, broadband, salaries, for example. And the way we would do that is we do our gross profit minus all our other costs, or minus our expenditure. So you can see in this case here that you do 30,000 less all those other costs, and that leaves you with £1,700. Again, if you're not fully au fait with this topic, make sure you check out my other videos on gross and net profit, which explain this concept in more detail. So, here we have a statement of comprehensive income. Now, gross profit obviously is all the money that you make on the items you sell. And we can actually start to do something called the gross profit margin ratio. And this helps us to make an assessment on how well the business is performing. So you can see here in my example that I've got a different statement of comprehensive income that's been calculated your gross and net profit. But I'm going to try and do my gross profit margin ratio. So to do this, I need to know the formula, which is gross profit divided by the turnover times 100. So I can pick out the numbers, as you can see here. So I can get my 35,000, which obviously will be my gross profit. I can divide it by my 50,000, which is my turnover, and multiply it by 100, and I get a gross profit margin of 70%. What that means is that when I sell a product, I'm making 70% product on every item that I sell. So I'm making 70% on every sale I make. But remember, at this point, I've not taken away all my other operating costs or expenditure. So just like the gross profit margin, we can do the net profit margin. Now remember, net profit is the profit that an enterprise gets to keep after all its expenditure has been taken away. And the net profit margin ratio does exactly the same as the gross profit margin ratio, but it calculates it for the net profit rather than the gross profit. So surprise, surprise, the net profit margin is your net profit divided by your turnover multiplied by 100. In this case, it'd be 5,000 divided by 35,000 and then multiplied by 100, and that would give you a net profit margin of 10%. So that means that the business is basically making 10% profit at the end of the year on what it's taking from its turnover once its expenditure has been taken away. Now, you might be thinking, well, are those figures good or bad? Well, really, it all depends on industry standards, and more importantly, you have to consider the gap between those two. So if your gross margin was 70%, but your net margin is 10%, that means that 60% of your costs are operating costs. Now, that is potentially quite concerning and quite high. So maybe you're trying to look to lower your operating costs. And that's one of the assessments you can make from using this calculation. So why don't you try it yourself now and try and calculate the gross and net profit margins from the example below. Pause the video whilst you do that. So here are some past questions that you could look at which are based around the topic which we've just covered. So you may want to undertake the question and then unpause where we'll show you the answer. So you can see here that the answer there would be £24,817. How would you do that? Well, you know that to calculate your gross profit, you need to do your revenue minus your cost of sales. So you've got your turnover and you've got your cost of sales. Very simple. Show you working, pick up the 2 marks. That's the way it would be done. So here's a slightly different question. This question requires you to calculate the net profit margin. I'd advise that you obviously use the formula appropriately, but then just write down your answer and remember to show it as a percentage. Hopefully you got the answer of 13.7%. If so, that is correct. And we have a question now where you need to complete a statement of comprehensive income. Now notice that you need to fill in some little sections. So you've got a section, and I'll just put my pointer on the screen for you so you can see where I'm talking. You've got this section here, and you've got this section over here, and down here, and down here. Each one is worth 1 mark. So you need to put in what you would get when you do your sales and cost of sales, and hopefully you work that one out. You need to calculate it then. You then need to work out your total expenses, so you need to work out what you're going to do there. And then you've got, so I'm hoping you calculated gross profit there, and you got 77,500. Your total expenses were 50,000 when you added those numbers together, and your net profit would have been 27,500. If you got them right, well done, you got yourself 4 marks. Right, now it's time to start to look at the second document, and this is a statement of financial position. Now I've got 3 questions for you to think about before we move on to this topic. So by looking at the data in that statement of financial position, how much is the enterprise worth, how much does the enterprise owe out within a year, and how much has been invested into this enterprise. Pause the video while you think about those questions, and then unpause as we go through the answers. Right, so let's look at the answer. So the first thing that I asked you to do was I said to you, how much is the enterprise actually worth? Now, the answer is 50,000. How have I calculated that? Well, it's down here. This total assets less current liabilities. That is actually how much it's worth. And it tells you that down there because that's the value of the company. The next question is, how much does the enterprise owe out within a year? Well, actually, that is what's called either a creditor, so people who owe the money, or trade payables. So obviously who it owes money to, it owes £4,000, so it's got to owe them money. And lastly, how much has been invested in the enterprise? Well, look, shareholders' funds down here. It tells you they've put £20,000 for shareholders' capital and £30,000 retained profit, and the amount that goes there is £50,000. Hopefully you notice that these two numbers match, and that's really important because that shows it's correct, because this document used to be called a balance sheet because the amount of money invested in the business would always equate to how much the business is actually worth. So your assets less your liabilities. So firstly, before we go any further, you need to complete some research for me to establish what each of these key terms mean. In a minute, I'm going to ask you to pause the video whilst you find out what an asset, a fixed asset, a current asset, a liability, a current liability, a long-term liability, capital, retained profit, and share capital actually mean. When you've done this, unpause the video so we can start to look at this topic in more detail. What does a statement of financial position actually show? Well, it shows the value of an enterprise, and it also shows where the money has come from that's being used to finance the enterprise. So in simple terms, it shows your assets and your liabilities. And you will have already learned that the word asset means items you own, and liabilities are things that you owe. And that's why owning is good and in green, and liabilities, obviously, things you owe, are in red because that's potentially bad. But let's delve into each of the rows and look into more detail. So, we start with our fixed assets. Now, the word fixed in finance means longer than a year. And obviously, assets are things we own. So they are items that you own that are going to take longer than a year to turn into cash. And underneath that section, you can see in my business here, I have a building and I have equipment. So the totals always go over to the right-hand side. So you can see there that 25,000 plus 10,000 gives me £35,000 of fixed assets. So items that I own, but will take longer than a year to turn into cash. Then we have our current assets. Now, current assets are items that I own that will take less than a year to turn into cash. So, for example, we have stock, sometimes called inventory. I have debtors, so people who have a debt to me, so they owe me money, or trade receivables. So the same thing, it's just a new terminology. And then I have cash in the bank. And I can add those three different types of current assets, things that I own that I can turn to cash within a year, and that would give me £19,000 in my total column in this business. Now, the most important thing to remember here is that of current assets, we have different gradings. So the best current asset is cash, because you can use it when you want to straight away, followed typically by stock. But stock isn't so good because, as you will probably be aware, when you've got stock and you want to sell it quickly, you need to have a sale. And that means that you're not going to get the full amount which you think that you're entitled to for that item if you have to sell it for a lower price. And then lastly, we have debtors or trade receivables. These are people who you've given credit to. So for example, it might be a customer who you've given them 30 days to pay you. So you might have given them some time to pay because they haven't got the money up front, or maybe they've had a large order from you and you want to give them some time to obviously sell some of that order, and then they can obviously pay you, and that builds a good relationship with the customer. But because this is a debt and because it's not being paid, you always have the risk of it remaining unpaid. So that's why many people don't class the debtors stroke trade receivables as being a really good current asset. Now on the opposite side, we have current liabilities. Now these are debts that need to be repaid within a year. And it's back to that word in finance of the word current and liability being a debt. Now, in this case here, we only have one type of current liability. That is what says there, creditors or trade payables. So these are actually suppliers who've given us credit. They've given 30 days to obviously pay them, for example, but in 30 days time, £4,000 in this case needs to be paid. Now, because there's only one item on this section, it moves straight over to that other side. So you see on that right hand side column, it moves straight over because it is a total on its own. Now, the next key term, and the one that likes to be asked lots in the exam, is the term net current assets. And that basically means, what have you got in total in current assets? And to do that, you need to do your current assets minus your current liabilities. So in this case here, you've got £19,000 in current assets, and you've got £4,000 in current liabilities. So you take them away and you're left with a total of £15,000. So that means you've got £15,000 at the moment in the business at any one time that you could use. So that's currently available. Now there is another column underneath there. Now you may have seen this one that says there, no, total assets less current liabilities. What that actually means is what it says. Your total assets, so your fixed assets and your current assets, minus your current liabilities. And when you do that calculation, you're left with £50,000. And that is the value of the enterprise. So at that point there, you know how much this company is worth. Now the final section right down the bottom here tells you where the finances actually come from. So in this case here, you've got money that's come from share capital, £20,000. You've also got £30,000 from retained profits, and in total that gives you £50,000, which balances the amount of money that was invested in the company and the value of the company, where you'll see above. Now what's important to say here is share capital is money that you raise from selling shares, and retained profit is profit which you kept back from a previous year. So if you made a profit last year and you kept some of it back and you used it this year, that's retained profit. Right, so we can actually do a little bit of ratio analysis on our statement of financial position. One of the ratios we can use is the current ratio. We do this by doing current assets divided by current liabilities. So in this case here, it would be £19,000 divided by £4,000. And that would give me the answer 4.75 to 1. Now you're probably thinking, why have I put it to 1? And what does a 4.75 to 1 actually mean? Well, 4.75 actually effectively means I have £4.75 in current assets to every £1 of current liabilities that I have. So in other words, if I was to shut the business down today and have to pay off all my debts, for every £1 of debt I've got £4.75. So I've got ample amount of money to be able to pay off my current liabilities. So in other words, I have a very strong liquidity position. The time to worry is if that figure was obviously less than 1. So if I had like 0.5, that would mean I have 50p of assets currently available to every £1 that I currently owe out. And at that point there, we've got a problem because I actually can't meet my current debt liabilities and the current debts that I have to pay. We always express the answer to be 1 against 1, so every £1 of liability. Hopefully that makes some sense because we have another ratio. We have the liquid capital ratio. Now this came about because some accountants, and I've mentioned it earlier, they have some concerns about different types of your current assets. One of the concerns that some accountants have is the level of stock, because some people believe that stock is very good, but if you haven't sold it, it's actually worth nothing. And if you do need to sell it quickly, you've got to reduce it so it becomes worthless or worth a lot less than what you think its value is. As a result, the liquid capital ratio does current assets less stock, in brackets first, divided by your current liabilities. So in other words, this is seeing how much you should actually get in cash in the bank, and obviously how much you should get in from your debtors and your trade receivables. Now when I do this calculation here, what you end up with is 19,000 is your current assets less your inventory or stock, which is 2,000. So that gives you 17,000 divided by the 4,000, which gives you a ratio of 4.25 to 1. So now we have £4.25 in current assets to every £1 of current liabilities. So we're still easily able to pay off our obligations in this business. Of course, this would normally lower the figure below 1, and it wouldn't be a problem normally if this figure was between 0.75 and 1, because it's assumed that 25 pence then, obviously what you require comes from your stock, and you'll be able to find that. But what you'll again be looking for is the difference. So if, for example, like you just seen a minute ago, the current ratio was considerably greater than the liquid capital ratio, that could be an indication that the business has got too much stock, and one of the solutions that it needs to undertake is to sell off some stock to free up some capital, which we all know is money, which obviously puts cash into the bank rather than being tied up in stock. So the best way to do this is to actually have a go at some past exam questions. So here you can see that you've got a statement of financial position, and you're being asked to calculate the net current assets and the net assets. Remember, you're going to need to use the formulas which you need to learn for these two calculations. See if you can do that. Pause video while you do, and then unpause for the answers. So, hopefully you've calculated net current assets for £4,050, and you've done that by doing current assets minus current liabilities. So you remembered your formula. And you've calculated your net assets is £70,550, and you've probably done that by getting your fixed assets and adding it to your net current assets, because that is, remember, is the total value of the company, what it's worth at this current point. If you got that right, well done. If you didn't, obviously look at how it's calculated and then give yourself some time to try and practice and get it right again. Now we have a different type of question. Now it's a bit of ratio analysis. So you need to calculate the current ratio, and you need to do the liquid capital ratio. Notice you're given the formula, but you need to obviously use the numbers at the top. Pause the video while you do that, and then unpause to see the answers. So hopefully you've got the answer of 1.5 to 1. So that means they've got £1.50 in assets currently to every £1 they owe out currently in liabilities for their current ratio. And they've got 0.6 to 1 when it comes to their liquid capital ratio. So that means they've got 60 pence in assets to every £1 in liability when they take away their inventory or stock. Now, if you remember what I said earlier, that potentially could be concerning because that suggests they're holding quite a lot of stock. In an ideal world, you'd want that to be something around 0.75 or greater. So maybe this company does actually hold too much inventory. And finally, we have two terms. So what is meant by the term creditor and what is meant by the term capital. Pause video while I answer these and then unpause to see the answers. So a creditor is somebody the business owes money to and has to be paid. Simple as that, 1 mark. And capital is all the money invested into a business or where the money invested in the business actually came from. So I must have told a bit of porky pie there because I've managed to find another question. So you've got to do this one where you've got to complete a statement of financial position. So you need to calculate the total fixed assets, you need to calculate the debtors, you need to do the net current assets, and you need to do the net assets. Pause the video while I do this and then unpause it to see the answers. So hopefully you've got your total fixed assets as £6,415. You've got your debtors at £939. You've got your net current assets at £313. And you've got your net assets at £6,728. If you have done, then you've obviously used the formula correctly for your net current assets of current assets minus current liabilities. And you've then done your net assets by doing your total fixed assets plus obviously your net current assets. Hopefully you got those answers correct. If you have, well done, you really do understand this topic. So there are some key things to cover just before we finish. Revenue is not profit. Revenue is money that goes into a business. Profit is what you get to keep after you've taken away all your costs. And I think let's use an example to think about here. B sells bottled water for £2. B sells 300 bottles a week. So what is B's revenue? Hopefully you've calculated that as being £600. £2 times by 300 is £600. That is revenue. Whereas each bottle cost B 50p to buy. B has to pay weekly rent of £50. So what is B's profit? Hopefully you've worked out the answer of being 300. If you're thinking, how have I calculated that? Well, if each bottle costs 50p and they sell 300, I need to multiply the 300 bottles by the 50p. And then I need to also add on the weekly rent. That gives me total cost of £300. And when I take that away from my revenue, I'm left with a profit of £300. It really is, hopefully, as simple as that. The other thing to say is liquidity is not profitability. Liquidity is the ability to pay your expenses. And really, the best way to do that is to show you this by explaining how a profitable business can fail. So, here is a cash flow forecast for the first 3 months of a business. Now, where does this business have a liquidity problem? If you look at the data to this side, see if you can spot where there actually is a liquidity problem. Also then consider, when you think you found it, what is actually causing the liquidity problem. Pause the video while you look at this now to try and see if you can spot it. Don't worry about the quarterly total. That is there to demonstrate that a profitable business can have a liquidity problem. Okay, so hopefully you've identified from these questions that I put on the screen that the real liquidity problem is in the closing balance for month 1 and month 2. You will see that the bank account is actually overdrawn. That means that this business technically has run out of money. It either needs to go to the bank and get an overdraft, or it needs to find some other form of finance to ensure that that money it's borrowing it can actually borrow. If it can't, it's said to be bankrupt. And the other question was, why is that being caused? Well, because they're buying new machinery. And the other question there is, well, what could they do about that? How could they change that? Do they need to buy that machine in month 1? Could they use a different form of purchasing, for example? Like, could they lease it? Or could they hire purchase it? Or could they pay it in installments? These are all valid questions that might have an impact on profitability. But it's vitally important to show you that the net profit over that quarter, if you look at that final column, is £4,900. This is a successful, profitable business. However, it has a serious liquidity problem for months 1 and months 2. This is a typical example of a liquidity problem in a business. You have a profitable business that's going to make a profit, but in the short term it has a liquidity problem. Hopefully that example shows you why liquidity is different to profitability. And remember that profit is revenue minus costs, whereas liquidity is all about whether a business is able to pay its current expenses. Hopefully this lesson and video makes some sense to you. If not, don't forget I've got a range of extensive resources on this topic which you can cover. There's also a series of quizzes and questions which are on my website. And obviously you can always follow me on the social media platforms and ask any questions or get any additional resources. You know what I'm going to say now? Until next time, keep buzzing.